Hi, everyone. Welcome to the Time and Research Show for April 20th, 2015. Um, Today we will be talking about the 82nd weekly reports. If you haven't had a chance to download this yet, just go to TimingResearch.com/reports, and you can download this or all past reports there. I have Dave Landry guest hosting for me again this week, so I'm going to go ahead and turn it over to him.
Okay, thanks to Timing Research for having me back, and also thanks to you, David Cosman, for having me return once again as a host this week. This week we have AJ Brown of TradingTrader.com, Glenn Thompson of PacificTradingAcademy.com, and John Netto of the ProteanTrader.com. And all of these guys are veterans to the show, so welcome back, everyone. AJ, let's start with you. Tell us a little bit about your trading and tell us a little bit about TradingTrader.com.
TradingTrader.com's been around since 2003, and we've been a very good source for people who are looking to learn option trading, equity option trading. And yeah, that's about it. We're a good place for tools, good place for community, and that's what we do. We trade together.
Cool. Okay, Glenn Thompson of PacificTradingAcademy.com. You're up next. Tell us a little bit about your trading for those of us who don't know you, and tell us a little bit about PacificTradingAcademy.com.
Sure. PTA, or Pacific Trading Academy, is an educational institute. We've got a number of mentors. I kind of focus on the technical instruction. Curiously enough, I started my career as a fundamentalist, but I don't focus on that as of about 20-some years ago, but I primarily, again, focus on teaching, and I've been teaching with them for about 14 years now.
Cool. Okay, next up we have John Netto. John's the only person I've actually met in person. We met down under. When was that,
Whoa.
John? About 6 or 7 years ago?
Whoa.
It's been a while. So, oh, wait a minute. We met in Australia. I guess that sounds a little bit better. All right, John, tell us a little bit about your trading, and tell us a little bit about the ProteanTrader.com.
Sure. John Netto. I'm a cross-asset class trader, focused primarily on futures. I'm also author of the upcoming book, The Global Macro Edge, Maximize and Return Punitive Risk, and president of the Protean Trader. Protean is a Greek word which means highly versatile, easily adaptable, and able to take on many shapes and forms, and that encapsulates the range of trading strategies I use when looking at the market from a return punitive risk basis. And everything I do incorporates the macro narrative and strong technical signals to assess which markets, which strategies, which portfolios are performing best on a unit of risk basis. And that's the essence of what I do.
Cool.
Thank you.
Cool. I like that Protean thing. At first I thought it was a low-carb trader, but now I get it. That's really cool. My name's Dave Landry. I'm DaveLandry.com. I've been trading for 20-something years. I stopped counting a few years ago now that I'm getting older. I believe that you can only predict the short term when it comes to markets, but you can stay in positions longer term. I am a stock picker. I think there's inefficiencies that occur in stocks that don't occur often in other markets. If you are going to trade certain markets like Forex, which I will do on occasion, which are more efficient, I think you have to pick your spots carefully. I have a 21-page report on my methodology, so if you're interested in that, just see my website. It's actually in the store under free reports. Okay, let's go with question of the week, or first question, I should say. Based on any technical, or AJ, you're up first.
Okay, so looking at the market in the short duration for just this week, I'm going to say that it's going to go up. It's going to go up against that level of resistance, and they're going to have a stall, just like we had last week. But as far as where are we going to end by Friday, a little bit higher. My confidence, though, just because that resistance is tested so heavily, and it could be something like a transient, I call it a transient external stochastic shock, some news headline that throws things down. My confidence is around 60%. Or what do you like, 6 out of 10?
Yeah, 6 out of 10. Okay, cool. And the question was, he read the question ahead of time. So the question was, and this goes to you, Glenn, based on any technical or fundamental indicators you want to use, would you predict that the S&P 500 index will move higher or lower this week? And that's Friday's close, April 24th. And based on your answer, go ahead and rate that on a scale of 0 to 10, with 0 being no confidence meaning there's a 50-50 chance in your prediction working, and 10 being extremely confident, meaning that there's a 100% chance you believe your prediction will work.
Sure. This would be, I think, an easier question for me if it were at the end of today's session, but I'm going to go out and give it based what I see so far right before I check with you. So far, it looks like we have an inside day today in today's session in the S&P relative to Friday's big range. Based on that, I'm going to say we're going to close the week lower. I've actually got a target around 2059 basis the June contract in the S&P as a potential target. And I'll give that about a 7 on its 1 to 10 scale.
Okay.
Cool. Do you want me to elaborate or just leave it there?
Well, next question.
Okay.
Save it for the next
Sure.
question. Yeah, because that's the next question actually. Okay, John Netto. Based on any technical fundamental indicators you want to use, would you predict that the S&P 500 will move higher or lower this week? And that's Friday's close, the 24th. And then after you give us your prediction, let us know your confidence based on the scale of 0 to 10.
Higher 9.5.
Wow. We only had 110 in this show so far, but that's the highest I remember. Very good.
I'll explain.
Okay.
I'll explain on the next lap.
Okay, cool, perfect. Yeah, that'll work even better. I'm going to go with higher. My nickname in the industry is a trend-following moron. 20 years ago, somebody called me that, or 20-something years ago now, and it wasn't very. They weren't being very kind at the time, but the name stuck. But I think that you're better off just erring on the side of the longer-term trend. I think only in a couple of these reports this week, since I've been hosting, I've been negative. But from now, but what I've been doing over the last, I don't know, dozen sessions or so, is just looking at the longer-term moving averages, looking at where the market is, where the market was about a year ago or so, and a few months ago, and so on and so forth. S&P is a little range-bound. We'll get to that in the next question. But for the most part, as long as we're at or near new highs, I believe that you should err on the side of the trend. So I'm going to go ahead and give myself an 8 on that, and I'm going to go up with the prediction. Okay, now we get to elaborate a little bit. AJ, you're first, and let me get the official question read, just for those who don't have the report in front of them. What developing events, and they can be technical or fundamental, would you be watching out for this week that might have a positive or negative impact on the S&P 500 and other U.S. markets? And before you answer, just by the way, you can download this report at TimingResearch.com. Okay, AJ, to you.
I personally am following just for the week. Now, I'm with you when I'm talking about doing some trades that are 3 or 4 weeks or even a month in length. But for this week, which is I think what we're focusing on, I'm focusing a lot on what's coming out with the headlines around Greece. I'm focusing a lot around this earnings season because I think that's going to have a major impact on what's going on. In fact, a lot of us here at Trading Trainer are trading volatility plays with our options on a lot of these earnings, looking for the volatility crush. And I'm just following as we push up against, from a technical perspective, we've got an ascending line of support and we've got a real heavy tested line of resistance that I'm seeing on whether you're looking at reversals, whether you're looking at just price levels, price and volume levels. So I'm kind of marrying it all and seeing that everything looks to be coming to a culmination like on Wednesday or Thursday, and I'm going to be interested to see what happens on those days.
Cool. Okay, Glenn, same question to you. What developing events, and they can be technical or fundamental, will you be watching out for this week, which is the 24th, that might have a positive or negative impact on the S&P 500 and other U.S. markets?
I would say to pick up on what AJ just mentioned, the developing situation in Greece, and I believe the deadline, they've got to resolve something by Friday the 24th. I think that's a factor as we look towards the end of the week. And then we've got some earnings, I know, coming out fundamentally at the end of the week. I think Google or Facebook. What do we got? Apple Watch as a big development here in the U.S., I guess, or worldwide also. The other factor I wanted to mention, my guess is one of the fundamental catalysts for what we're seeing so far today is the situation in China, the rate requirement pull down, and I just don't know how significant. I think initially traders are reacting to that bullishly. I think once they look into that and think about it and reflect on it, that's going to, I don't know that that's a bullish catalyst to the market. I think ultimately it's going to transition and become more bearish. Long term, I am bullish the stock market, but I've got a time target coming in coincidentally this Sunday, the 26th, so I think that'll manifest whatever impact it has as we move into next week. If you look at the top that happened in the S&P last week, when I put that together, what we've been doing essentially since that top through today, through this very moment, is trending down. So logic suggests to me if my next time target, for which I have about a 90% confidence level, is coming in on the 26th, and again that would correspond to a week to today since the market's not open really on Sunday, I expect overall the trend is going to go down. But again, that's in this relatively short window of time between now and the end of the week. After which, when we hit the start of next week, I expect the market to find support, possibly that 2059 zone, and move up into around for the next 3 to 4 weeks, because my next time target for the broader equity sector is May 25th. But again, short term, in the next week or so, I expect overall prices to decline through a combination of the fundamentals and the technicals. If you look from that top that came in on December 5th, you got some long-term divergence for some of the generic oscillators. So again, very short term between now and the end of the week. Again, that's my major reason. If we see anything, if they don't have a resolution with the situation between the ECB and the IMF in Athens, and between that could be serve as a fundamental event that could be the factor that the market would cite as an event to cause that. But again, overall, just meshing all of these things together, I think we're going to go down into the end of the week. But my primary factor is this time point I've got coming in on Sunday. And so when I factor that into account, take a look at the major, what's the market doing now? I'm working on the principle of inertia and of expectation that the market's going to keep moving on into that low. And then from that point, move upward and possibly break out into new highs. That's my thought.
Okay, sounds like you got a lot of work there. John, let's go to you.
Yes.
What developing events, and they can be technical or fundamental, will you be watching out for this week that might have a positive or negative impact on the S&P 500 and other U.S. markets?
Sure. And can I circle back because I got disconnected there in terms of I'll weave in number 2 there as well, so I can sort of it all makes sense. Couple of things here that I look at markets not only on an individual basis but on a collective basis, and I'm always measuring which markets are maximizing return punitive risk the best. And this year, by far, Japan, Europe has outperformed significantly in terms of on a nominal and risk-adjusted basis. So we've seen incredible outperformance from European equity markets relative to that of the S&P 500. We've also seen outperformance of the TOPEX, the Japan market, and the China market overall in terms of how they've outperformed as well. Now, what's interesting is that energy has been a big drawdown on the S&P 500. Okay, the energy stocks for I'd say the first 10 weeks of this year were really a laggard, and over the last couple of weeks with this rally in crude, we've seen that change significantly. So we're looking at mathematically a market today in terms of when you ask the question, where will we be? We close higher or lower from Friday's close to next Friday's close. We're already up 1% on the week as it stands right now. Okay, so we also have what I see is some flows coming out of European equities, which have significantly outperformed, and back into the S&P 500, which is going to put a bid into the S&P 500. You also have, of the 9 sectors in the S&P 500, energy, which is going to catch a bid as this rally in crude continues, because energy stocks have been a laggard or part of the downside of the S&P. That dynamic is changing right now. Okay, and so yes, I understand some of the technical aspects in place and the desire to take on long volatility exposure, and given the event risk that we could see Friday with the Greece situation, that could unfold itself, and obviously Apple and Google are factors as well. But specifically the S&P 500, those bigger earnings are more NASDAQ and beta focused. And if we're talking pure underlying S&P 500, I think they're of less consequence. Now clearly, Apple is the ultimate bellwether stock of all the markets out there, but it is a little more tech side than the S&P side. To me, the bigger story is the performance of energy stocks. And given that we're up over 1% on the week in S&P 500 already, and given the energy stocks are outperforming, or that oil's making new highs right now, new monthly highs right now, the sustainability of oil margins are going to increase, and European equity outperformance could see some of those asset flows flow back into the U.S. again. This gives me a high conviction rate that relative to Friday's close, we're going to close higher in the week, and that's why I gave it such a high percentage.
Oh, amen. Plus one on those energy stocks. For those of you who don't know John, he doesn't drink coffee, and I don't know where you get your energy. you still off the you still staying off of caffeine, or?
No caffeine, no alcohol, no caffeine, no drugs. Never have. Just not my thing.
Good for you. Good for you. Well, I have caffeine. I'm not on drugs, but no caffeine.
I need caffeine as well to get going.
Yeah. Yeah. Amen. Okay. As far as I'm concerned, I ignore all news events. Usually I get some through osmosis. I was at American Association of Professional Technical Analysts meeting over the weekend. That's the AAPTA. And they were talking a lot about Greece, too. I wasn't even aware there was a situation in Greece. So I just try to avoid as much news as possible. It's kind of interesting. Earlier I said err on the side of the trend. And one simple concept, not that you want to mechanize this and trade mechanically off of this, but one simple concept that's kind of neat when you're looking at longer-term trends is to plot like a 200-day moving average, or you can plot any average that you want. But I like the 200 because it's well-watched. And I like to look for what's called daylight. The lows are greater than the moving average. I wrote an article in 1995, I don't want to digress too far, for stocks and commodities, and it involved the moving average system, and somebody coined the phrase daylight in that. And what's kind of fascinating is we've only had about 5 days of daylight in the last 80-90% run in this market going back a few years. So I find that kind of fascinating. So just to err on the side of the market, err on the side of the moving average will, in general, keep you on the right side of the market. Of course, when there's trends, one thing we discussed over the weekend is everything works better with trend. Now, we did have a sell signal a while back in the S&Ps, a little shorter-term sell signal, but that didn't materialize, and we only went underneath the 200 today. It only worked about 8%, and we did just kind of dip below the 200-day moving average. The other thing that I find kind of fascinating is that every time this market has a little bit of a spill, all the bears come out of the woodwork like it's the end of the world. And what's fascinating to me is that the market comes right back. Like today, we're already back 1%, so we made back quite a bit of Friday's losses already. But if you talk to people on Friday, they just say, this is it. I told you the market is topped. And so just keep erring on the side of the trend and honor your stops just in case the trend doesn't continue to materialize. Now, right now, I am seeing more opportunities in emerging trends than longer-term trends. So you've got areas like biotech and especially like retail. They're looking a little tired. Retail kind of crashed a little bit on Friday. And I think those areas the trends are getting a little bit mature there. Not that I won't take setups if I see it, but I think the real opportunity is in emerging trends. China, especially the second-tier stocks, not so much the FXI or the ETFs that are going straight up. The second-tier stocks, for instance, like JMEI, we're long that stock, full disclosure, I think could provide a lot of opportunity. Brazil looks good, too. I noticed that over the weekend. We had some people talk about Brazil and Latin American stocks. And I like the EWZ as far as an ETF. I'm not a big fan of trading ETFs because they're too efficient. But every now and then you can get an inefficient move. So coming into the day, we have what I call a bow tie set up in the EWZ. And if you look at my YouTube channel, there's some videos on that. And the other thing I'm bullish on, +1 with John on the energy, is that, I always learn something from these shows that I wasn't thinking about the energy component in the S&P 500. So that's going to help out that S&P quite a bit. You think that, you want lower energies, it's better for the economy or whatever, or the overall market. But actually, if those stocks start going up, they're going to pull up the S&P with it. So thanks for bringing that up, John Netto. So that's where I stand. I think these emerging trends, again, China, Brazil, and the energies in general, you could throw a dart at a lot of these energy stocks have been beaten up. A lot of bow ties out there, a lot of setups, and a ton of setups coming into the day. But we're already fairly long the energy, so we didn't take any new setups. But I think that's probably the best opportunities or in those areas. Okay, let's go to the final question of the week, and let's go to AJ once again. Let's start with you.
Dave, I have something I wanted to say here real fast.
Okay, go ahead.
Yeah, for the on the survey this week, the fourth question was, if you could spend a day with a professional trader, what would you most like to learn from them? But since you guys are all established professional traders and educators, I was thinking maybe if you could talk about, for someone who was new to trading or relatively new to trading, if they spent the day with you, what would you most like them to learn from you about your trading style?
That's a good question. I like that. That's a great question. So let's go to you, AJ. If someone were to spend a day with you, Say that again, David. What would you most?
Yeah, if someone who was relatively new to trading spent the day with you, what would you most like them to learn from you about your trading style?
Perfect. Great question. All right, AJ, let's go to you.
The one component that I would want somebody to walk away from me with, especially with the option trading that we do, is measuring and doing scenario testing ahead of time, and not so much focusing on the profit potential, but on the risk. And I'd like them to really understand risk management. In other words, position sizing, making sure your portfolio can withstand a certain number of losses, and making sure that you know how to pull out of the market and go back to some paper trading, simulator trading, when it's not the market forces that are having you losing trade, but you. So being able to be very clear and working with them on a lot of the mental mindset, but also money management skills. I think that's where I'd like to start, where I'd make sure that they walk away with, before I even got into pattern recognition and then pattern utilization with option trading strategies.
I like that. I'm glad you brought up risk management. I was making some notes while you were talking based on that. So, amen and +1 on that. Glenn, let's go to you. Same question. If someone that's fairly new to trading would spend a day with you, what do you think would be the best thing for you to teach them?
Yeah, I would second AJ's emotion there. The stressing the importance of combining not only performance ratios, or not focusing solely on all of your trading, but just combining reward-risk ratios and juxtaposing them with the performance ratios. When I began, again, more than 30 years ago, and I'm aging myself, it was extremely, I focused primarily on what system, what methodology, what approach overall could gain or extract for me the best performance. That, if you look at that in a vacuum or in isolation, you're cheating yourself, and in the long course, I think you're not going to see a complete or as comprehensive a picture. So certainly, the melding together of both performance and reward-risk ratios is essential. As a broader backdrop to that, I think especially, and I do this with the students and traders I work with and have been for, as long as I've been teaching now, is the concept when you're putting together and trying to figure the big picture out, recognize, number one, that the entire process of speculation is, you got to think of it in terms of probabilities, or it's a probabilities-based concept or endeavor. So if you guide all of your analysis and everything you do within that broader context, I think that'll do you well overall. I take it to the extreme. I say when you're developing a method or a system, my primary philosophy of system or methodology construction is utilize a number of very, very different modalities or relationships. You derive your premium of edge primarily, I believe, as a consequence of combining the different components or constituents, and it's out of those inherent or intrinsic differences where you get, when you do, the edge that you acquire. When different relationships or indicators or models that you're using, in spite of those intrinsic differences and sensitivities to different types of market motion, sometimes align, that's what piques my curiosity, and that's a hallmark, I think, of robust system development. So I would stress that more important than the intrinsic value of one model or one indicator or one system is the combining of these constituents that comprise your methodological soup, in a sense, that is going to get you your edge. It's not a question for me of like, do I use technicals or fundamentals or quantitative? These are all just labels to characterize different types of information. Where when I started my career, the very first book I ever read was Fundamental Analysis by Benjamin Graham. That's a world apart from what I do now, but it's a start. It's a type of information. I found that when I was building up my fundamental arsenal and knowledge base, I became just that. I had a burgeoning amount of knowledge. I personally was not able to translate that into consistent dollar and cent profits. When I kind of reversed my protocol and started from the technical, tried to interpret charts, and then that created in my thinking more or less a certain predisposition in terms of the types of events worldwide that is fundamental that would need to, occur, that could be potential catalysts to bring about the most probable technical scenarios that my chart analysis was telling me. So again, I would stress to a new trader, just mix and match different things. and make sure that they're different. And to that extent, you're more likely going to, more often than not, be on the winning side of things. But again, to go full circle back to what AJ said, performance by itself is not the whole picture. You got to I see all the time different methods. Oh, 80% performance. I win 80% out of every 100 trades, or this or that. Again, combine that with your reward risk. What's the magnitude of your gains relative to the magnitude of your losses? So you got to put it in that broader context, I think.
Yeah, amen. I mean, I just recently wrote about anthill strategies. You can be very accurate, but like an anthill, a big footprint comes along, wipes you out. And if psychologically you can survive that, then you got to start all over. And it's a couple years before you're back to where you were, and it's just not worth it. I agree with you 100% on that. And I want to comment on some other things you said, but before we do that, let's go to John. I think you're last up on this one. John, if someone were to spend a day with you, somewhat new to trading, what would you focus on, and what would you teach them in that day?
First of all, is that advisable that anyone just sit next to me for a full day, guys?
Hey, don't set yourself up, okay? I spent a weekend with him in Australia. So anyway, no, go ahead, John.
Yeah, it's just some amazing points by Glenn and AJ there. I couldn't agree more. One thing that I would say comes down to 3 words, and really something I focus on in my book, The Global Macro Edge, Maximize Return Punitive Risk, is identify the regime, okay? And I apply both a technical, a fundamental, a macro narrative, market sentiment. These are all key factors, and one of the biggest things that people run into, one of the problems they have, is that they take, let's just say very simple, a moving average crossover system, but we're in a mean reverting regime with low volatility and high correlation. Okay, so when I look at factors of a regime, I look at what's the correlation between various asset classes. What's the volatility, both intra-volatility and inter-volatility amongst asset classes? How is are we in a market that is in a period of price discovery? Are we in a period of consolidation? And so if you back test a moving average crossover system, I'm saying this on a very basic level, okay? That moving average crossover system will do very well in a period of price discovery and high price momentum and high correlation. However, that same system will be much less effective in a mean reverting market and low volatility and high correlation as well. And
Amen.
So I think the key
everything
is
works better with
give
trend.
But conversely, if you run a mean reverting strategy or even a short volatility strategy where you're selling options, you want that mean reverting market. You don't want trend following market. So there are multiple strategies, and ultimately, I'm trying to build a portfolio that maximizes return punitive risk by incorporating a number of positive expected, uncorrelated strategies together. And the only way that you do that successfully is by properly identifying the regime that you're trading in. So the first thing I would emphasize to someone is identification of regime will dictate potential profitability of strategy, because those performance metrics that AJ talked about and those various constituents that Glenn just went into are viable and become much more viable and much more robust if they are applied to the proper regime. And that's a lifetime to learn right there. That's a decade or 2 decade endeavor, but it all has to start, somewhere.
Yeah, if you go spend a day with John, you better bring a coffee pot, because that's a lot to learn in one day, John. But I do like a lot of what you said, especially about identify, hey, are we trending or not? And there's different ways of doing things. As far as I'm concerned, I believe in doing one thing and not trying to be everything for all markets. I've tried doing that, and then I just have followed back on the trend following. So I would emphasize that you do one thing, and sometimes you might just have to wait for your pitch and sit it out. And there's nothing wrong with doing that. Don't put that pressure on you for that constant performance. I like what Glenn said about probabilities. One thing that a lot of people are shocked about is that anybody who's a real professional, such as us here, I don't want to brag about us too much, but we'll tell you on any given trade, we know we might be wrong, because, as I say in my disclaimer, all predictions are about the future, and a lot of stuff can happen between now and then. I would emphasize keeping it simple. I would teach them some very simple systems, and I'd say go out and follow those systems religiously and develop the psychological ability to be able to follow those systems, good, bad, and indifferent. And psychology, I'd probably spend a lot of time on psychology. Speaking of that, I would tell them to plan your trade and to trade your plan. I would teach them what trend is, and it should be obvious. Right now, the S&P is not intermediate term obvious trend, but longer term it's still in an uptrend. So I would teach him how to look at trend and just use some very simple things such as moving management. I like what AJ said about risk management. Plus one on that, again, like Glenn said, we could be wrong on any given trade, and I think everyone here realizes that, as it just said. So you got to have a stop on every trade. You get stopped out, so be it. Again, I can't say it enough. Plan your trade, trade your plan. I'm just going to reiterate that a couple times. Recently, the market started selling off. I started to get a little nervous about the market. We had a whole bunch of longs, but what did I do? I didn't do anything. I let the stops take care of the positions. And luckily, knock on wood, it doesn't always happen. Trust me. Sometimes we get knocked on everything. But those positions, since the market sold off in that sell-off in March, or some of them are 50%, 60% higher than they were back then. That doesn't always happen, but if I'd have bailed out because I was nervous, I would have missed what could be the biggest trend of the year. These China stocks and these biotech, some of these tech stocks and all. Sometimes if you pick your stocks carefully, they'll trade independently of the overall market. Just a couple of more things. I did say stock selection. I think stock selection is very important. I wouldn't have time to teach them everything they need to know about stock selection. I think that does take a while to learn. It's one of the few things of my methodology. It does take a while to learn. But I would teach them something really simple. I would teach them to pick a stock that's at an obvious trend or an obvious emerging trend with something like the bow tie pattern like I talked about earlier. And just avoid stocks that look like electrocardiograms. I get stocks charts from people all the time that looks like electrocardiogram. And in fact, I'll put it next to electrocardiogram. And electrocardiogram actually has a better structure than the stock itself. So if you're trading trend, you can't. You're not going to catch a trend where there is none. And again, wait for your pitch. If the market is not conducive to your methodology, then just sit on your hands a little bit. And you could do that by again picking the best stocks. If you can't find any setups to trade, then don't trade. When I first started a trading service years ago with trading markets, when I wouldn't put stocks on, the salespeople would call me up and say, "You got to put stocks on. People are quitting." But if I put stocks on that didn't work, nobody would quit. People just crave the action. So forget about the action. If you want to be successful, if you want action, do what you want. But if you want to be successful, and then finally, once again, just know your methodology. Know that if you're trading momentum, there's going to be some times where you're just going to have some flat period where there is no momentum, and you might have to sit on your hands. And then the last thing, again, well, second to last thing, I guess. But the other thing, just final thing I should say, is the secret is there is no secret. I just wrote a little. Somebody asked me to write a little. I think it was Financial Juice wanted a seven steps to success type of article, and I called it 7 Secrets to Success. And the first secret was there is no secret. Like I said earlier, we don't know where the market's going to go. So just to reiterate, keep it simple. Money management, and then psychology would be just to plan your trade and trade your plan. Now I went a little long on that, but I think I kind of hit on all the points that you guys brought up. So you guys, the whole time y'all were talking, I made a big list of things I wanted to talk about. So I appreciate all the. I was kind of easy going last on that one, so thank y'all for that. Okay, let's go back to you, AJ, as we close up the show here. Any final thoughts about your trading, the markets, anything we said today? We got plenty of time, and anything else you want to tell us about TradingTrader.com?
So the scoop that I wanted to emphasize as well is I agree when I heard, I think it was Glenn say that, these technical analysis, fundamental analysis, quantitative analysis, they're all labels and they're all just tools that we use. And I like to think of things very similar to what you were talking about. You're going to identify a pattern and then you're going to fit the right trading strategy to that pattern. And if you want to focus on one set of patterns, you just wait for that to go around. One of the things that we're doing here, because of the ability of options to be able to do good hedges, is we're offering a little webinar, since the market is been in a sideways kind of choppy pattern, webinar this Thursday where I'm just going to go over 9 different ways to make sure that what you're seeing is, we're going to use fundamentals, technicals, go through some different tools, 9 different tools we can do to verify that it is indeed a sideways type of, like you said, electrocardiogram looking patterns, and then 5 option strategies that actually profit off those patterns that we can use reliably. So it seemed timed perfectly, but that's what we like to do. So again, I think it was I don't remember who said it, But they were saying that you got to understand what the market's throwing at you before you go back and try to trade it with a particular strategy. And so for this particular, options are ultimately flexible. That's why I got into them. So yeah, if you wanted to be part of that webinar, you just have to visit event.tradingtrainer.com, and you'll be able to register. And even if you can't make it on Thursday night, you should register. We'll get you the recordings. But it's going to be a really worthwhile webinar for what's happening right now. Event.tradingtrainer.com.
Cool. Okay, Glenn, let's go to you next. Any closing thoughts? It could be about your trading style, about PacificTradeAcademy.com, and/or anything that we discussed up until now in the show.
Sure. Yeah. Two things immediately popped to my head. One is picking up on one of the items. I think John had mentioned something about, more or less intermarket correlations, in particular with regard to oil. I did some work over the weekend, and now, in all forthrightness, I'm aware that I think OPEC has a meeting coming up June 5th, the first week in June. But here, as unbiased and as objective as I could be, I projected a time point for the energy sector, June 1st. So it's closely enough correlated for me to suggest, or for me to take that as a possible turning point. I know the line that the Saudis and within OPEC have indicated that they're planning to keep production more or less at the same nationally and as far as OPEC at large. But my thought is that the move we're seeing in the energy sector right now, I'm still looking at this as a bear market. That may be kind of a contrarian or a little bit off the majority view, but and I know we've broken through some resistance levels, and I certainly expect that the rise is going to be beneficial and serve to bid equity prices up here for the short term. But again, my time horizon specifically is as we move into June, I'm expecting a turn in energy prices. Is it the OPEC meeting that occurs June 5th? All I know is that I projected a time target for which I have about a 90% confidence of reliability coming in on June 1st for crude. And to what extent that interplays with equities here, I'm not certain, but that's my data right now. And then a final thought, it ties in with the final question, the original question. Then even though I've been doing this for some years, I'm constantly looking to learn more things. And one thing that I thought about that I kind of, in my own repertoire and toolbox, I'm not ashamed. It's just, it is what it is. In an ad hoc fashion, I need to find better ways by which I can forecast volatility for my options trading, because I think principally and theoretically, the way I think about options, I want to compare my implied volatility to my forecast or future. Anyone can, the market. Implied is what the market says an option ought to be priced at, basically. But similar to a trader and I trade the underlying assets, let's say in the S&P and in forex trading and other derivatives primarily. But for a pure options trader, their forecasting quest is what's the volatility going to be out like a month from now, 3 months from now, 6 months. My best tool, and it's the one I use primarily or depend on and what I teach, but I'm not purely 100% satisfied. I'll look at things like volatility cones. I'll see where the patterns have been historically, and if I see current volatilities that are extreme percentiles, that's how I get a sense as to whether or not to make forecasts. If anyone, or if I could get a finer mechanism by which I could predict future volatility, that would be something I'm still open to learning to add and improve my methodology, certainly, because I think that would ramp up the performance of my overall option strategies.
Yeah, I mean, I think everyone, all good stuff that you just said, I think everyone thinks that once you become quote-unquote a pro, you know everything, and that's not true. I just spent a weekend with a bunch of really smart guys taking a lot of notes and listening in on things, and you learn things like Larry McMillan, a good friend of mine, was there, and he talked about actually if something has a high implied volatility, maybe somebody knows something, and maybe there's an option strategy you might want to employ on that's not actually selling the option, which is the common common knowledge. People sell high implied volatility. So sometimes you got to look at things a little bit differently, and it's good to get out and talk to a lot of people. And as I say every week, I learned so much in these shows, and then today is no exception. I've certainly learned a lot so far, and I got some notes and things I want to look into so far from this. But last and certainly not least, we have John Netto of the ProteaTrader.com. John, tell us, let us know if you have any closing thoughts, anything you might want to add, and or anything we talked about already you want to talk about. So floor's to you.
Yeah, just very briefly, Dave, and to Glenn's point about trying to find a better implied volatility model, my friend, we're all always trying to find ways to price implied volatility better. Okay, that's as dynamic and as complex as trying to price the market itself, but clearly a key factor in terms of where technical projections can go. So +1 to you for acknowledging that that's a factor in how you're supposed to manage risk and gauge performance. So good stuff there. In terms of what I do, guys, I'm literally a complete professional cross-asset trader. 99.9% of what I make comes directly from my P&L and my futures account. That's how I've paid myself the last 5 years. That's how I've made my living. And I would just encourage you that, the book that I have coming out later on this year, The Global Macro Edge, Maximize Return Punitive Risk, all of the net profits that come from that are going to go to help. I spent 9 years in the Marine Corps, and they're going to go help train service dogs to come with to help wounded veterans and veterans coming back from Iraq and Afghanistan, or veterans from any who served in the Army, Marine Corps, Navy, Air Force that have served this country. These guys need help. They've made a tremendous sacrifice for this country. I was in the Marine Corps myself. I'm aware of the challenges that our veterans are facing. And service dogs take a lot of money, take a lot of time, take a lot of skill and know-how, and a lot of these guys aren't in a financial position to support them. So I'm trying to bring awareness to this cause. Myself and other panelists today are very blessed to be doing what we're doing. And for me, it's an honor to be able to write this book, which is going to blow the door off in terms of Wall Street, in terms of teaching the reader how to look at a trade, a strategy portfolio from a return per unit of risk basis, and in the process raise money for a very worthy cause. So I'll just leave on that note.
Oh, good stuff, John. God bless you for that, and thank you for your service. We get a lot of service minute here, so thank you so much for that. We appreciate that. Okay, AJ started talking about a webinar on Thursday, and I was like, oh, goodness, I got a webinar on Thursday, but it sounds like his is at night, so it looks like you'll be able to go to my webinar and AJ's webinar. Weekly, I do Dave Landry's The Weekend Charts. It's usually on Thursdays, but we might be mixing that up a little bit and mixing the times up a little bit. It's usually Thursday morning. See my website for more than that. We have a lot of fun in the webinar. We don't take ourselves too seriously. I'm going to reiterate a lot of the concepts I talked about today. We usually end up talking about money management, psychology, and, of course, everybody's a setup junkie, so we'll talk about setups too. This week we'll probably take a look at China, and I'll show some of these emerging trend patterns that I'm seeing in some of these second-tier companies. We'll also take a look at Brazil, and I'll show you how it's set up there. Right now, the open portfolio is doing extremely well, so I'll give you a peek at that. And then the reason I like to do that fairly often, even if it's not doing so well, is just so a year from now or 2 years from now, we could pull that old portfolio up and see what worked and what didn't. I take everyone's questions. It is an interactive webinar, and as I say each week, without you, there is no show. And then in the last session of the show, we take stock picks, and then ideally you want to know a little bit about the methodology, so read the report. So just try to make sure your stock is trending to begin with. But if you like some stocks that are trending and you think they're set up, or you want my opinion on them, feel free to bring those to the webinar. Okay, great show, if I say so myself here. But you guys did a wonderful job. This was a really fun show. I don't want to talk too much about how great it is, because someone else could say, well, what about my show? But this was really one of the great shows, if I say so myself. So, Dave Kosmitter, let me turn it back over to you, let you close things up. Thank you for having me here, and thanks to TimingResearch.com for promoting this show, or providing the show.
Yeah. Thanks, guys. Yeah, really good show, like Dave said. So I just want to remind everyone who's watching, if you haven't had a chance to look at this report, or if you'd like to look at any other of the previous reports, just go to TimingResearch.com/reports. Also, be sure to go to TimingResearch.com/current survey sometime next weekend or later in the week, so you can fill out the survey for next week. And I just want to thank my guests again: AJ Brown of TradingTrainer.com, Glenn Thompson of PacificTradingAcademy.com, John Netto of theproteintrader.com, and of course Dave Landry. Thank you for hosting again.
Thank you, David. And also, just a reminder that David does upload these shows to YouTube, usually shortly after the show for those who are watching live. And then obviously like the show for David, and I'm sure he'll appreciate that, just to kind of remind everyone to do that. And thanks again for having me, and then we appreciate all you guys being here today. Thank you so much.
Thank you, guys.
Thank you, guys. It was great stuff. Be good, everyone.
Thanks again.
Okay.
Take care.
Yeah.